Welcome traders. If you are searching for how to use leverage, this video is the best for you. When I started trading newly, I researched and discovered that many people who tried to explain leverage got me more confused. So after trading for years, I've decided to make this video to help those struggling with leverage. So make sure you watch this video to the end so that you get everything you need as it concerns leverage. Let me list the things we are going to look at in this video. Number one is margin. We are going to talk about margin. Let me number it. Number one, margin. Number two is liquidation. Liquidation. Number three is equity. Number four is margin level. If you are a new trader, you must have seen the way most traders present leverage as a very complicated part of trading, and the kind of fear they try to put in new traders when it comes to leverage. But I assure you, by the end of this video, the fear that you always have that you blow your account when you use leverage will disappear, because you are going to understand everything concerning leverage. So let's get started. Assuming we have a trading account of $100 account balance, let's write it, equals $100, and we want to use leverage in this account. Before we start, let me define leverage. What is leverage? Leverage is simply a borrowed money from broker that allows a trader to place a higher position that the money in the account cannot place. Just as the name implies, you leverage on the money made available by the broker to buy a higher quantity of the assets you wish to trade. So we have a trading account of $100 and we wish to place a trade that is greater than $100 in terms of units. We can use leverage to achieve that. Let me list some available leverage. We have 1:1. If you open your trading account and choose leverage of 1:1, what does this mean? It means that your account balance will be multiplied by 1 and you still have the same total of $100. Your buying power will still be $100. So you have it here, $100. So you cannot buy any assets above $100 here. Remember, there is this misconception that people have when you use leverage, the profit you get or the loss you get will be multiplied by the leverage you have. That's not true. But at the end of this video, you are going to understand. Let's just take it one by one. We have leverage of 1:2. Let's write it, 1:2. And you have account balance of $100. your buying power will now become the $100 you have multiplied by 2, which will give you $200 because of leverage. We are using leverage of 2, 1:2. So you multiply your account's balance by these 2 here to get $200. So the maximum maximum units you can buy from $100 account is $200 using 1:2 leverage. Let's take another example. If we have 1:10, 1:10, the maximum units of assets you can buy using 1:10 leverage is 1,000 units. So this is it. Let's take the next example. 1:100. If you have 1:100, 1:100, the maximum units of assets you can buy is 10,000 units. Is $10,000 here. If you are using a 1:100 leverage, then if you are using 1:200, 1:200, the maximum units you can buy is 20,000 units. 20,000. So this is what you have, 20,000 units. I'm giving you multiple examples like this so that you'll be able to understand this thing. If you have 1:500, the maximum units you will buy is 50,000. 50,000. Just the $100 times 500 will give you 50,000. For this side, the $100 times 200 will give you the 20,000. So that's how we are getting this number. Let's continue. If we have another one, 1:1,000. Let's say we have a leverage of 1:1,000. The maximum units of assets you can buy from the $100 account is 100,000 units. 100,000 units. So let's try another one, like 1:2,000. Before we move to the next thing, 1:2,000. The maximum units you can buy is just to multiply the 2,000 by 100, which is your account size. You have 200,000 units. 200,000. You cannot buy beyond 200,000 units on a 1:2,000 leverage account. And let's take the last one for this particular stage. 1:unlimited. There are some brokers that have unlimited leverage. And make sure you watch this video to the end so that you know how to use leverage. 1:unlimited is available in some brokers. So if you are using 1:unlimited, this means you can buy as much as your account can hold, like your margin. When I get to margin, I will explain what I mean by that. So let's continue. Another important factor when you are using leverage is margin. This margin is the minimum amount required to open a position. So how do we get the margin? Margin is simply trade size all over leverage. Trade size all over leverage. So most people think that using a higher leverage will make you blow your account faster, or using a smaller leverage will help you save your account. This is not totally true. It depends on how you manage your risk and the part of your account you are exposing. Because even if you use a leverage of 1:1 and over risk, you will still blow your account, which you get to understand by the end of this video. So in order not to bore you, let me show you how to choose the right leverage. We have stated our account balance as $100, and assuming we've done our calculation and got a lot size of 0.1, remember you will have to calculate your lot size based on the amount you are willing to lose or risk in the trade. You don't just assume lot size and enter it on your trading platform. No, it is not done like that. You have to calculate your lot size with respect to the amounts you are willing to risk on a trade. I've done a video about lot size. So if you don't know how to calculate your lot size, you can watch the video on this my page. So let's continue. Assuming we have analyzed charts, we know our stop loss, our entry points, and our take profit points, and came up with lot size of, let me indicate this 0.1 as lot size. Lot size equal to, let's have it here, 0.1. Then, and we have a trading account of $100. If we use this particular trade here, this leverage 1:1, you see that we will not be able to place this trade because lot size of 0.1 is equivalent to 10,000 units of the asset. These have 10,000 units. 10,000 units. This is a mini lot. I know a mini lot is equal to 10,000 units. So you can see that our account here is $100, and the total units it can buy is 100 units. So we can't place these trades with a leverage of 1:1 using lot size of 0.1. If we check the second one here, you see that we have 1:10, and what we have here now is 1,000 as the maximum we can buy under leverage of 1:10. So you can see we can't place this trade with a lot size of 0.1 using a leverage of 1:10. If we use 1:100 leverage, the maximum unit we can purchase here is 10,000. As you can see, the unit we have here is 10,000. So from this particular formula here, we can simply impute our trade size to know the right leverage that we will use. So let's just do the mathematics together. We have 10,000 units over, let's start from the first one, 100. We've seen it now that what we have is, do the math on your calculator with me. Let's make it interactive. Type 10,000 divided by, let's start from the first one. 10,000 divided by 1 is going to give us 10,000. So we need a margin of $10,000 to place this trade. So you have seen that we don't have $10,000 in our account. So we can't place the trade with leverage of 1:1. For 1:2, we have our leverage as 2. So if you divide 10,000 by 2, we see that you still need $5,000 as margin to be able to place the trade. So using a leverage of 1:2, you cannot place the trade. Let's come to 10. If you divide 10,000 by 10, we see that you have 1,000. And you know what we have in our account is just $100. So this cannot go. We cannot use leverage of 1:10 to place this particular trade with 10,000 units. If we use leverage of 100, so divide the units by 100, we have $100. So we need minimum of $100 to place this trade. But you know, this is the account balance we have, and we have to pay some fees and commission. We cannot just carry all the money we have on our account balance and place as margin. So we need to give it a space. If we use 200, divide it by 200, we need like $50 margin of $50. So from leverage of 200, we'll be able to place this trade with lot size of 0.1. So from this to the last one, which is unlimited, we can place the trades. So let's also check for 500 and know the margin we need there. If we use leverage of 500, we just divide the 10,000 units by 500 to know you have $20. Just need margin of $20. So if you try for 2,000, let's say we divide 10,000 by 2,000. Let's write 2,000 here. Margin is equal to the 10,000 units over 2,000, which will give $5 margin. Before I continue, let me illustrate something for you here. Let's assume you have one crate of egg. Let's write it, one crate of egg. one crate is equal to, let's assume it has 100x, and cost per crate can be $1. Cost per egg, sorry, can be $1, $1 or $0.5, $0.5, and $0.25. And a crate contains 100 eggs. So at $1, you will have only one crate. Number of crates is equal to 1. I want to use this to explain leverage. Then, and the number of eggs is 100. Number of eggs equal to 100, and crates equal to 1 too. Then, if the buyer buys at $0.5 per egg, the buyer will have 200 eggs in quantity, and the crate will be 2. And we have another one here at $0.25 per egg. The buyer will have 400 eggs in quantity, and the crate is going to be 4. The broker is giving free crate for each 100 egg the buyer buys. So the number of crates here represents the leverage, which is free. And for the buyer to get one crate, the buyer needs 100 eggs. So it depends on the amount the buyer buys that will determine the quantity and the number of crates the buyer will have at the end of the day. So this is what happens. Assuming the buyer has an account or has a balance of $100, what happens is that if the buyer buys at $1, the buyer is going to have only 100 eggs. And if the buyer buys at $0.5 per egg, the buyer is going to have 200 eggs at the same account balance, with the same account balance. At 0.25, the buyer is going to have 400 eggs and 4 crates. This is just how leverage is. The balance will remain the same, but the quantity will depend on the price at which the buyer buys. The higher the quantity, the higher the number of crates, but the balance will remain the same. As you can see, what is increasing here is quantity, not actually the balance on the account. The balance is the same, but quantity will increase or decrease based on the price at which the buyer buys. So you can see most of the time people think that the $100 will turn to $10,000. It is not true. What is increasing is the quantity, not actually the account balance. So that is it. That's why you will not make $10,000 when you multiply your $100 with 10x leverage. So I believe with this explanation, you'll be able to understand how leverage works. Let's move to the next example. Assuming we have a lot size of 0.01, which is a micro lot. Let's write it. Lot size. This is the second example. Lot size equal to 0.01. The number of units, let me adjust this so I can bring this thing closer. I have it here. The number of units for a micro lot is 1000. 1000. That's the position size. You just multiply this by 100,000. It's going to give you 1000. So that's it. The standard lot units. That's one standard lot is equal to 100,000 units. So this is just a micro lot. So if you multiply it by 0.01 by 100,000, you get 1000 units. So assuming we've calculated our lot size to be this, we need to buy 10,000 units. Not actually $10,000 of this. We are buying 10,000 units. That's in quantity, which I've explained here. So someone can buy at a cheaper price with a different lot size and still buy these 1000 units. Someone can also buy at a higher price with a higher or lower lot size and still get this same quantity. So it depends on the price the person is buying. So let's continue. So we need to buy 1000 units. And based on the leverage we have, without the leverage, we can't use $100 to buy 1000 units because $100 can only buy 100 units. So using our formula at margin, which is equal to trade size over leverage, we have to calculate and know the minimum leverage we use. Trade size is 1000. So we know what we have is 1000. Type it on your calculator. 1000 divided by 100. We just need like $10 to place the trades. You can use a higher leverage if you want. 1000 divided by 100 will give us $10 margin. So we use $10 from the $100 account to place this position with lot size of 0.01. If you need smaller leverage, you use higher. If you need smaller margin, you use higher leverage. So that is how it is, so that you have more available leverage to place more positions if you want. Yeah. But mind you, before you place any trade, make sure you know how much you want to risk. Use it and calculate your lot size so that you will not enter the wrong lot size that will blow your account while you are using leverage. Most people advise beginners to avoid leverage because some beginners don't really know how to calculate and manage the risk. But as far as you know what you are doing, you know how to calculate your risk, you can use any leverage of your choice. You can use unlimited leverage without blowing your account. I've also done a video on how to manage your risk. So go through the page, or I will link it to this video so that you can watch it and know how to manage your risk. Let's continue. I want to explain some important terms I listed here. We have equity. Equity. This equity is your account balance plus or minus any unrealized profits or loss from open trades. When you add your account balance and the floating profit and loss, you get your equity. We have another term I would like to describe here so that I will use them to explain what margin level is. We have margin level, margin level, and margin level is equal to equity over 100, equity over used margin, used margin multiply by 100%. Let me put this in brackets so that you will understand what I mean. Do this one first before you plan. So this is how it's written. Equity over used margin times 100%. This is in percentage. What is used margin? Used margin is the portion of your equity locked up to keep position open. We have another term we call margin call. Let's write it too. Margin call. Your broker sends a margin call when the margin level drops to a certain percentage, say 100%, 50%, or lower, depending on the broker. Let's have it. It can be 100%, 50%, or lower, depending on the broker. Some brokers can make their margin call at 100%, while some can place it below that. So let's continue. We have another term known as stop out or liquidation. Let's also write it stop out or liquidation. Liquidation. You can also call it automatic closure. Let's write automatic closure. Automatic closure. If the margin level falls to the broker stop out level, which is liquidation level, the broker automatically closes or liquidates all the position. The goal of liquidation is to protect you and broker from negative balance. So that's why liquidation occurs, to avoid your account having negative balance. So I believe this has explained leverage very well. I will still do a video on how to avoid liquidation. If you have any question, let me know in the comment section. Please make sure you follow and like. Make sure you subscribe and like this video so that it can get to others who are in need of it.